UiPath reported quarterly financial results after the markets closed on March 12, 2025. That disappointed stock market investors, and the stock is down over 10% on the day following the announcement. Of course, some of that has to do with a broader stock market decline, but some of that has to do with disappointment from the company's earnings results and the forecast for its upcoming fiscal year. So I'll review the latest figures from UiPath and update my recommendation because, of course, I'm upset about these results. I've had UiPath stock rated as a buy, and so I'm disappointed of the company's underperformance here and the falling stock price. I'll let you know if I still think the stock is a buy or if the results were so disappointing that I'm changing my recommendation. Let's jump in. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So for the latest quarter, UiPath reported revenue of $424 million, which was up 5% year over year. The company's revenue growth rate has been decelerating for several quarters now. The good news was the dollar-based net retention came in at 110%. The dollar-based net retention measures how much existing customers spend with UiPath in the second year. To me, this is a sign of customer value proposition. How much do customers feel like they're getting a good value with UiPath's business? If they feel like they're getting a good value, they'll increase their spending in the second year. If they don't, they won't increase their spending. And so this number highlights the fact that most of its customers in aggregate, feel they're getting a good value with UiPath, and so they keep spending and spending more in their second year. GAAP operating income came in at $34 million, and cash flow from operations was an impressive $146 million. If you take the cash flow from operations number of $146 million divided by the total revenue of $424 million, you get a very healthy cash flow from operations to sales number, meaning the company turns a good percentage of its revenue into cash flow from operations. That's a good sign for a business you want to invest in. And because of those healthy cash flow generations, the company has built up a cash hoard of $1.7 billion as of January 31st, 2025. So it didn't surprise me to see the company announce an acquisition in this earnings release, which I'll talk about in just a little bit. For the full year in 2025, the company reported revenue of $1.4 billion, which was up 9%, and non-GAAP operating income of $241 million. Cash flow from operations at $321 million, again, was a solid number as a percentage of sales overall. The company did make an acquisition. UiPath announced the acquisition of Peak AI Limited, an AI-native agentic application company that focus on accelerating AI adoption in sectors like retail and manufacturing to optimize inventory, pricing, and providing customers with tangible outcomes quickly without the need for large in-house tech teams. So this is a very focused company addressing a very specific need in the market using artificial intelligence. These categories are growing rapidly where businesses are looking to employ artificial intelligence to improve operations in categories like inventory management and pricing, right? How does a company approach pricing? Let's say because of tariffs, they're going to face higher costs. How do they approach that? Do they raise costs that they charge customers? If so, by how much? Let's say you're selling 2-liter bottles of soda for $2, and now because of inflation on plastics or metals or whatever the case might be, your cost just went up by 20 cents per bottle. So now what do? Do you still sell your soda for $2? Do you raise the price? If you raise the price, how much do you raise it by? The full 20 cents, 30 cents, 40 cents? That decision is a difficult one to make. And if you've been in business for a long time, you probably have a lot of data in various economic environments that you can put into an AI model, and the AI model can give you responses like, well, if you raise your price by a nickel, this is how much your total revenue would increase. This is how much your profits would increase, versus if you were to raise your prices by a dime, what would be the impact. And so you can look at several different scenarios relatively quickly using AI and make a decision based on optimizing all of that proprietary data, which is similar to what Peak Eye Limited does. So UiPath is entering into a category that's very highly in demand right now. Enterprises are looking to employ artificial intelligence in these types of ways specifically to improve their operations without needing to hire 10 economists and pay them $150,000 a year to do these calculations in an Excel spreadsheet to come up with suggestions. Now, with companies like Peak AI and other AI services, you can make those decisions and do those analysis at lower costs. For the first quarter of 2026, which is their next quarter, the company's forecasting revenue of about 330 million, which would be a deceleration from the previous quarter. And that's partly what had investors upset about the quarterly earnings results. And then for the full year, they're forecasting revenue of about 1.525 billion, which would be an increase from the current year, but not by very much. And investors were hoping for much better increases, especially because they recently made an acquisition. The company saying non-GAAP operating income will come in at about 270 million, which would be more than what they reported in the current year, non-GAAP operating income of a little less than 250 million. So they are expecting increases in 2026. And typically, when a company makes an acquisition in the first year, that acquisition hurts the profitability of the business. And then starting in the second or third year is when it starts to benefit the company in terms of profitability once they digest the acquisition, streamline, find synergies, find areas that are overlapping and let go of some people and cross-sell some opportunities. And then it starts to benefit. So the first year is typically a down year as a result of the acquisition, and then it boosts up following that. So following this stock price decrease, which has been so common for UiPath, unfortunately, over the last year, it's now trading at a forward price to earnings of 18, which is the cheapest it's been in the last year. Also, I updated my discounted cash flow model for UiPath today on March 13th, incorporating the latest free cash flow forecasts. And my intrinsic value per share actually increased by a couple of dollars. It was formerly about $20, the intrinsic value. It's now $22. And that's more than double the current market price of $10. So I still see UiPath stock as being considerably undervalued, although this is one of those risky situations where the company is struggling to recover, one that might take some time for the stock market to react to the decisions that UiPath is making. And it might be a value trap. It might be one of those situations where you feel like you're getting a good value, but instead you're in a trap where the company keeps decreasing and decelerating and going backwards and thereby hurting the business value. Still, I think the risk versus reward is worthwhile, and I still have UiPath stock rated as a buy today, March 13th. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.